Welcome to the next installment of Opinions of Value, Valcre's very own virtual chat series. We're glad you could join us for today's episode. This series was created to encourage open and honest dialogue about the health and state of the commercial real estate industry through the lens of commercial appraisers. On Opinions of Value, we will explore everything from the trends shaping the commercial real estate market at large to the challenges impacting the way valuers conduct their jobs in this digital age. We're excited to dive into this month's episode with an amazing panel of guest speakers. Please welcome our first guest, Jeff Enright from Kidder Mathews.
Thanks, Lucas. I'm Jeff Enright. I'm a managing director with Kidder Mathews here in the San Francisco Bay Area. Kidder Mathews, by the way, is a full-service commercial real estate firm. Our valuation division has about 50 appraisers working from a little more than 20 offices, mostly up and down the West Coast. I have been an appraiser for about 35 years, and during that time, I've done a good amount of my work here in the San Francisco Bay Area. I have been involved in valuations in Southern California, Sacramento as well, but my function here is to help lead a group of about 10 appraisers in mostly Bay Area work.
Excellent. Thank you, Jeff. Next up, Jim Newell from NAI Partners.
Thanks, Lucas. Jim Newell. I'm a director of institutional valuation in our NAI Partners, which is based out of Houston. I've been focused primarily on institutional valuation for nearly 15 years of my 20 plus years of appraisal work. Over the last 10 years or so, I focused primarily in Western US, kind of Texas West. We currently have a team here in Houston of 10 appraisers, and we are NAI's sole valuation. And so we're working to set that standard.
Amazing. And our very own Grant Norling.
Thank you, Lucas. Grant Norling here. I'm a co-founder of Valcre, and I'm the vice president of client experience. My job is to onboard clients across the US and make sure their experience is great with our platform. My background is 20 plus years of commercial real estate appraisal experience. First 15 years were at Colliers International, and then I started my own appraisal company that was for 5 years. And I've been with Valcre the last 10 months in my current capacity. I'm glad to be here, Lucas.
Great. Thank you all for joining. This episode, we'll be discussing the future of office, which has experienced its fair share of disruption these past 2 years during the pandemic. At the start of the year, office owners, investors, and financiers were reading the tea leaves and taking a wait and see kind of approach to assess if tenant demand would ever return to pre-pandemic levels. Now, we're finally beginning to see the dust settle, and it's really revealing what appraisers have known for some time. Jeff, let's kick it off with you. At the height of the pandemic, when the lockdowns occurred, were you surprised by how hard the office market was hit?
Yeah, that's a good question. I guess to frame that, we'd have to define the height of that pandemic. And, to me, that is probably somewhere starting around the first quarter of 2000, running through the end of the year. A lot of folks in our line of work were scratching our heads wondering, what's going to happen. Obviously, the pandemic itself was a big concern on everybody's mind. And what we saw primarily during that, call it 6 to 9 months or so, until we heard about the initial vaccines coming out in the beginning of 2021, was just the lack of activity, I guess. A lot of the world, as everybody knows, came to a halt. That certainly impacted the office sector as well. We saw deals that were in the works in the first quarter of 2000 put on hold, deals both from a leasing standpoint and an office purchase standpoint. And a lot of people, as folks were stuck in their homes working and obviously not coming into the office, were wondering what the future of office was going to be. That hung on for the better part of that calendar year through the end of 2000. And to answer your question, I guess I wasn't surprised as much as I, like most people, were wondering, well, where's this all going to go? What is going to happen once we can get back to the office, when people can start looking at, either from an appraisal standpoint or a simple office use standpoint, where are things going to happen?
Jim, any additional thoughts there?
I agree with most of what Jeff said in terms of what we saw as well. I think the way we viewed it, I think that the short answer is no, I'm not surprised at how hard it was hit when all of a sudden you take everybody out of the office. It just scares the hell out of everybody, not knowing when anybody's going to come back, and knowing what the leverage any employer has to get people back. So, which I think plays into kind of the market dynamic as a whole. If, when can you force people back? How do you force them back? Do you force them back?
Yeah. And in the course of your guys' business and doing appraisal work, how did your clients really react to this disruption in the market in your normal course of appraisal work?
I think for us, the initial take was that this is probably going to be a temporary issue, so let's not freak out. There weren't a lot of capital markets changes. It was mostly, how do we handle this in the short term? What's it going to do to, lease up times, things like that. Nobody wanted to jump ship immediately. I think as it's gone on, certain clients have started to reduce their positions in the office market and reallocate. I think, especially as different sectors have performed, better over the last few years through kind of the pandemic and recovering out of it. So I think it's kind of two ways. Like in terms of their underwriting and how they were approaching valuations, they were definitely cautious, but not in a long-term view that this is going to be the end of office as we know it. I think that started to change a little bit, though.
Yeah, and I guess I'd echo that too. What we saw, again, back at the height of the pandemic was, an initial slowdown in lending. That part of our client base, like most people, backed away, and we're considering where the market was going to go. We spent a fair amount of time during that 6 to 9 months doing a lot of hand-holding with our institutional and owner-user type clients. Folks that were, simply wondering, well, what is it that's happening to values? And of course, the thing that we all struggled with was, well, in a market with a lack of activity, it's kind of difficult to understand where values are going when you don't have the price points. There were sectors of our business line that continued pretty much unabated. We had a fair amount of estate-related work, eminent domain work by municipalities that kind of kept moving forward because there are longer fuses on those deals and those thought processes. One area, I guess, back to your question about surprise, I had thought early on and kind of carried this through into 2021 that property tax appeals might gain legs. And there, has been some of that, but clearly not as much as was the case, say, back in the era of the great financial crisis.
Yeah, it's kind of interesting. I was interested to what type of appraisals were actually in high demand during the last 2-year period, because, I would have thought tax appeals would have been up there as well. But was there anything that was really in high demand?
From the office side, no, I would say, and we're talking a span of now 2 years since the pandemic started. And clearly the 2021 timeframe, we saw lending come back just fine. Now we're in a period where, and this is probably a COVID influence as well, the very recent rise in interest rates and the spikes of inflation are starting to impact the lending side again. And I guess that speaks to, something I'm sure we'll get into in this conversation, which is, it's really tough to look at the market with one broad brush to say, what's happening to office, because there are so many sectors. There's so many different clients with different needs for appraisal services. And even inside office space, there are very different things that have happened the past 2 years that are continuing to happen, whether we're talking about Class A product, commodity Class B, C product, high-tech office campus environments. I mean, those are all functioning differently and very different things happening in those sectors.
Yeah, and it really feels like the office sector was shielded to some degree during the initial onset and the peak of COVID. because you have these contracts in place where businesses are obligated to continue to pay rent. There are certain federal programs like PPP help stabilize these businesses. And in general, businesses were profitable during COVID. And so it wasn't as big of a deal to continue to pay rent because they had an effective business solution in place. And now as things continue to move forward and we see vacancy continue to rise, it kind of speaks to the instability of the office sector right now.
Yeah, so that kind of leads into the next question about vacancy on the rise. The Wall Street Journal recently reported that a record amount of available office space is about to hit the office market this year, with JLL estimating more than 240 million square feet of office space that will expire this year. What does that really reveal about the current state of the office sector in the US?
Yeah, what's been surprising, well, not surprising, but interesting to me in watching the office market evolve, and Grant makes a very good point. A lot of this ties back to the length of leases and when the market is able to start to react to differences in demand. A lot of these contracts are signed with 2, 3, 5, 10-year terms. And to Grant's point about PPP loans and many businesses being able to get through the initial phase of the pandemic, they're only now, as we move into 2021, now 2022, dealing with issues of, well, hey, the lease is coming up. What are we going to do? Whether it's a law or accounting or tech firm, what are we going to do with space requirements? A lot of the brokers at Kidder Mathews are reporting, and again, this breaks up different market sectors and different parts of the Bay Area at least, but they're reporting that many companies at the time they're looking at their space needs are definitely cutting back. They're saying that going forward, we don't need the amount of space that we wanted in the future. Clearly there's a demand for office. Office is always going to be needed in some respect, but with these companies now competing with a work from home environment, which, we're also still in a spot where I think employees have the upper hand with regard to the strong labor market we're in. If they're working for a company that doesn't give them what they want from a hybrid type work from home versus office environment, they can pick up and go somewhere else at this point. Now that may change going forward as we're thinking about where the world might be in another 6 or 12 months with, again, the changes in the economy happening. That could reverse and it could start to pull back some demand for office space.
Are you hearing the term right sizing again?
Absolutely.
Yeah, and I think piggybacking off of that is there's been a bit of a flight to quality. And that's what we're hearing from our brokerage team, especially here in the Houston market, which is hit hard on a lot of different levels, maybe out of proportion to the rest of the country, but definitely a flight to the best quality buildings, whether for health reasons. There's a perception of these cleaner buildings, UV systems in the HVAC, these fresh air, high-end gyms, things like that, like Jeff pointed to, you're competing for talent to come back into the space you have. And I don't think employers are overly confident that they have the leverage to force employees back yet. Now that might change as you start hearing whispers of recession and yells of recession, and it might swing that dynamic back in the employer's favor to where instead of having 10 jobs for every employee, there's 10 employees for every job. Maybe you can be a little more demanding with your employees are coming back to use the office space you're paying for, but in the meantime you definitely have seen the cutting back. So the numbers, I was looking at the Wall Street numbers too, the Wall Street Journal numbers too, and it can make sense because I don't think there's been enough new product brought onto the market too, that I don't think employers and tenants, I guess using them interchangeably, feel the need to take as much space now. So they're willing to downsize, and then they feel like they can always expand again later if they need to. So we'll kind of see where it goes.
One other thing that I would add is, as we're projecting forward and considering where this office market might go, and again, getting back to the point of there being a significant differentiation between commodity type Class B, C versus the Class A product, the campus environments that tech firms want. During the past year and a half, many of the bigger tech firms that are established in the Bay Area that we see and have been in Silicon Valley for quite a period of time, they're continuing to make commitments and long-term decisions to big blocks of space. I mean, whether it's Apple or Facebook, Google is definitely continuing to plan for major campuses just outside of San Jose. But these firms have all, committed to several 100,000 square foot blocks of new and existing space. And back to Jim's point, it's, and many times it's the new Class A stuff. It's the best quality product out there. And they are certainly making commitments now to know that their employees are going to be back ultimately. I mean, the blocks of space that they're taking right now are I think, votes of confidence that once we get 2, 3, 5 years away from this thing, we're going to be back in the office.
And that's what I found interesting too, is oftentimes those are the same employers that haven't been pushing, or they'll come out and say they're going to have everybody come back, and as soon as they get a little pushback, they walk it back. Amazon's given back a little space in Seattle, but I honestly don't know if has more to do with their dynamic with the city at this point, or the market, because they've moved. They're kind of shifting out of Seattle as heavily as they were. So you see those give backs, and they give back a few 100,000 square feet, and everybody kind of freaks out. Well, what's it going to be long term? But then they take down 700,000 square feet in another submarket. So
it seems like there's always a flight to quality, and the quality tenants are always going to be leasing up the quality office buildings, and that kind of creates an interesting dynamic within the office markets itself.
Yeah.
In another more harrowing report from NYU Columbia, research suggests remote work will cut office values by $500 billion in the next 7 years. From your perspective, do you think these reports have merit, or are they somewhat exaggerated? I mean, from an appraiser's point of view, you guys have seen cycles happen numerous times. This report seems like it's a little bit more narrow-minded.
I'm thinking of Jeff's market there, and I think when I started my career in the early 2000s with the tech bust and all the see-through buildings through Silicon Valley and a lot of the Bay Area, it's not hard to imagine that it could wipe off a significant amount of value if employers just can't get employees back and they have no need for the space. I mean, I think in the near term, nobody's really projecting that kind of hit because just the capital markets haven't been hit that hard. But as you're seeing interest rates, the rate environment change, it's going to start changing that dynamic too. So there's a lot of things in play. I think you're going to wipe some value because of that. You're going to wipe some value because of maybe the realization of long-term vacancy. There's going to be a lot of different levers that are probably going to get pulled in that equation. So.
Yeah, I agree. There's so many variables that go into obviously determining office property values. And if, we're kind of setting them on different sides of the scale right now, I think it's easy to say that more negative issues are popping up rather than positive. But at the same time, I look at deal flow and purchases that are happening here in Silicon Valley, and there are definitely office property purchases that are still occurring. I mean, it's important, again, to focus in on specific submarkets because downtown San Francisco, for example, is suffering, no doubt. But we see, on a weekly, biweekly basis, office buildings in, Menlo Park, Sunnyvale, San Jose, continuing to be purchased by investors. The prices that are being paid, I think, from a broad brush standpoint, don't show yet significant declines or changes in values in those markets. But if we, again, look at the different pressures that could influence things going forward, from a textbook standpoint, rising interest rates should be bringing property values down. At the same time, we've got inflation spiking, which is, from a textbook standpoint, supposedly positive for real estate. But, that's only if your income is rising faster than your expenses. And so there are a lot of questions about how is inflation going to impact market rents going forward versus, the more known categories of operating expense. Another very recent interesting dynamic that we're seeing is certain landlords become more aggressive or attempt to become more aggressive with their rates of annual increase. The historic 3% per year bump is now being set aside, and there's talk about, should we, as a landlord, push for 4%? I've heard 5% in rare instances, and from a broad property spectrum standpoint, those things I think are becoming more successful in maybe the industrial category, for example, where demand is still very strong. But it's happening on the office side too. So a lot of influences, a lot of different things going on, and be interesting to see where we are 3, 6, 12 months down the line.
Yeah, I think I would have to take an article like that, Lucas, with some sort of skepticism. The way it's worded, it says remote work will cut office values by 500 billion within 7 years. I mean, that's stating it as though it's a fact. Whereas, there's a lot of speculation going on in the office sector, and without really digging into their study, just the matter of fact by which just the article is described, it just to me it's difficult to take that serious, and it might be more of an issue of there's a stabilization that needs to occur in the marketplace, where there's going to be a high vacancy for a period of time, and over the course of X number of years, there's going to be a rebound in the marketplace.
That makes perfect sense. And kind of with that thread, hybrid and flex offices are becoming the new normal kind of post-pandemic, with companies and occupiers negotiating shorter lease terms and demanding more concessions at signing. How has the shift to hybrid work affected what is considered normal or stabilized vacancy in the markets?
Didn't know who was going to jump in there. I think we work, like I said, mostly core markets through the Western US, Texas. It's market by market. In general, I think speaking in general terms, what we've seen, it's similar to what you touched on, shorter lease terms. That's probably been one of the bigger things we've seen. There are very few 7 to 10 year deals being done these days. It's a lot of 3 to 5 year deals. If you can tie a tenant in for 10 years, you're probably giving away the farm with concessions, whether it's TI packages and free rent. Build outs have gotten so expensive that it throws that dynamic really off. I mean, you're really giving a lot away. I guess from a valuation standpoint, building in longer downtimes between deals, and then bigger concession packages. I think that's kind of what we're seeing in general.
Yeah, and I would agree with most of that. I think, so far in this conversation, we've touched on a lot of factors that are influencing office utilization and potentially values that are a direct result of the work from home environment we're in. I think longer term, work from home is probably going to be with us, in some form or another forever. I don't think that, the genie coming out of the bottle with allowing employees to split time between an office environment and a home environment is, going to be eliminated. I think that, companies are planning for that to be something that is built into their office needs going forward. We talked a little bit already about downsizings and right sizings. Companies, looking at with increased costs pretty much across the line, how can they become more efficient with office use? Whether that's looking back at the concept of hoteling of desks or shared office space for folks who maybe are in the office 2-3 days a week, that kind of thing. I think that, and then also the thought that, private offices maybe were highly demanded in the past. There's certainly a shift there occurring with regard to not only the cost of private offices, but the shared concept of maybe, a couple of folks using environments within office space when they're in the office on those days. So, going forward, I think that, we're going to be looking at this work from home environment as being something that's certainly not temporary, and it's going to be around in some form or another for a long time.
It's definitely something to compete with an office and somebody's couch at home.
Hey, Jeff, are you changing or making any adjustments to the stabilized vacancy that you're applying in your assignments right now to the office marketplace?
Yeah, that's a very good question. And I would tell you that so far the answer is no, but it's on the radar, and it's something that our group is starting to think about, depending, of course, on what submarket we're looking at and what property type we're looking at. Could we get to a point where, in the relative near term for Class BC space in markets with vacancies between 20 and 25%, is it at that point relevant to start looking at moving the typical 5% stabilized vacancy to 7.5 or 10? Sure. It's happened a couple of times over the 30, 35 years I've been doing this. The thing that I caution, and the thing that we talk about on current appraisal projects is, the effect of doing that in perpetuity. And then, of course, how that, if you're changing that variable, maybe influences other variables that you're looking at. But it's certainly something that is, it's on the horizon, and we're talking about it.
I'm curious what you guys think about the trend with flex offices and how that's really impacting the overall asset values that you guys are appraising. When you're doing a particular office building and there's a large amount of tenant space that's reserved for co-working and hybrid and flex office spaces, how are you valuing that if you are valuing it any different than typical?
Yeah, I don't know that I've seen it within a property that I've dealt with very recently to have an intelligent answer about that. The WeWorks of the world and the other executive office space, if that's what you're asking about, I haven't had to wrestle with that recently.
Yeah, I haven't really come across that much either. I think we have a lot of larger corporate spaces that they're trying to figure out how long-term they're going to deal with it, but a lot of them aren't even really back yet. I'd say one of the dynamics we've been a little surprised at, and I think it depends on the market. Like Jeff mentioned, downtown San Francisco, CBD's still pretty empty. Seattle's pretty similar, but downtown LA is reportedly come back pretty well. Multifamily's kind of bounced back along with it. Downtown LA had been really buzzing and then kind of just collapsed during 2020 and nobody was around. It was a little bit ghost town. I think our Texas markets were a little stronger to bounce back, getting people into the office. There's just more of a lack of acceptance that you can just sit at home. But I think going back, I think my big take on the whole office market, and I've said it already a couple times, is leverage. I think it's employer leverage on getting people back, and right now the employees absolutely have the upper hand, and if that stays, I think it's hard to justify having a whole lot of office space. So.
Yeah. Well, we've talked about a few items that are happening in the market. Potentially annual market rent increases. Going up to 4, maybe 5%. We've talked about how vacancy might be increasing. On a long-term basis. How might the majority of appraisers adjusting their evaluation process to account for the new normal in the foreseeable future? Like, are there certain things that you would expect to occur over the next few years?
Yeah, I would say independent of the variables that you mentioned, Lucas, which are obviously part of the thought process of any appraisal. One of the ways I think that real estate valuation for office buildings is going to change going forward is the need for a more focused highest and best use analysis. And, we've seen that on a couple of recent projects where, surprisingly, and this is all interrelated, it spans the different market sectors, but on the peninsula here, San Francisco Bay Area, for example, there are a number of cases now where sites with older existing Class B and C office buildings that, I think 90% of appraisers would take a look at from the freeway and say, well, there's a substantial project there. And even if it's got a high vacancy, it can probably bounce back with some TIs. What we're seeing is because of the strength in the biotech sector, some of these properties are being bought with the thought that, that whole building comes down. So a clear change in highest and best use there. There are other examples, again, because of the pressures coming from the biotech industry where some, borderline call them Class A, B buildings are being looked at for conversion to life science, which is, definitely not a cheap undertaking. And there is a lot of froth in that market right now in the biotech life science market, but it points back to, I think, for many appraisers needing to kind of open their thinking a little bit and don't just look at a Class B, C office building and think that because it's 20, 30 years old, the continued use for smaller tenant occupancy is something that is the highest and best use. The out of the box thinking about either redevelopment of the site or repositioning of the property to an alternative use is something that we're seeing happen in the market, and it needs to be thought or part of the thought process of appraisers.
Yeah, Jeff, I saw that with another transaction in Seattle, 1101 Westlake, I think, is bought by a bio fund, basically, that I primarily invest in buildings that are biotech related, but it's currently a Facebook building. But it's a newer construction property, but they look at it like long term. Well, they don't have to renew Facebook to begin with, but they can convert that building into more desirable space and take the higher rent along with it. I think another interesting point, and I don't remember what market it was in, but they're also starting to talk about converting some of these B buildings for multifamily use in certain infill markets where you can convert rather than tear them down. You can still convert them in a cost-effective manner. So, kind of interesting to see where it goes. Highest and best use in the institutional assets hasn't been a big analysis in the past because they're usually fairly straightforward, nice Class A stuff. But I think it definitely throws a different dynamic when you get into the long term. If you have a lot of B plus A minus buildings that are sitting there with people scratching their head on what to do with them, got to start getting creative. So
I think appraisers are going to remember how to analyze non-stabilized assets. As soon as a property falls in that non-stabilized or distressed sort of situation, the marketplace takes a totally different approach to how they're going to tackle the value of that property. There's more risk involved. There's more, if you will, blood in the water in terms of if that property had to sell today, what would it trade at? And so, it's going to be an asset by asset sort of sharpening of the pencil to, make sure that you're not treating every property like it's the same, because properties are going to be performing differently. And each one's going to have its own risk profile that the marketplace is really going to hone in on during these times of uncertainty. So I think that, understanding the performance of the asset, being able to determine if it has a high probability of becoming a stabilized asset again, looking at what the costs are going to be to get to that stabilization. That's, all the things that the marketplace is, and active buyers in the near term are going to be focusing on.
Yeah, are you guys seeing, obviously there's a difference in Class A, Class B, Class C, but are you seeing, how are office buildings faring in major gateway cities versus more suburban neighborhoods in secondary or tertiary markets? You guys seeing any differences there, or, valuation issues that are varying?
Yeah, I would say, speaking again for the Bay Area, absolutely there are differences, again, across property types and in different submarkets. We've talked a little bit about downtown San Francisco, and for the most part, things are clearly more negative there now than they were 2 years ago. But at the same time, when we've talked a bit about this flight to quality concept, I mean, that is happening. There are very high dollar deals being done for tenants in downtown San Francisco, whereas again, the Class B and C sector is probably taking the bigger hit as far as what's happening COVID-wise. Certain suburban environments, again, back to the peninsula and extending down into Silicon Valley, in those markets where, especially if you're close to mass transit, Caltrain in this instance, and you're in some of these markets where vacancy has not spiked and the fundamentals are still, fairly close to where they were pre-pandemic, and in some cases, back to those levels, we're not seeing a significant change. So I think we've talked a bit about this, but it requires, again, not the broad brush of what's happening with office values, but really what's happening with the specific type of office, and where is that property? What market does it function in? And again, on the high-tech side, properties that are occupied by the Googles and Facebooks and LinkedIns of the world, we've seen some recent deals where investors are, very happy to pay prices that, again, look like there's really no fundamental change as far as price per square foot, or at least the deals that have happened so far, cap rates.
Yeah, and that's where I think it speaks more to the class of building than location. I think class of building and location tend to go hand in hand. There's not a lot of Class A trophy stuff outside of CBDs. So if you talk about that flight to quality, it kind of inherently pushes into CBDs. But it depends on the submarket and the market. Like Jeff mentioned, along the peninsula, there's some high quality buildings built in what I think look on a map to be suburban, but I don't consider much of the peninsula at all to be suburban these days. But you're not in downtown San Francisco or downtown Oakland, maybe, but you get markets like Houston that don't have the CBD is where, and the Galleria submarkets are the primary Class A markets that you're going to have high quality stuff. You get out west, and those markets are just getting hammered. The energy corridor and other submarkets where there's more limited high quality space, and it becomes that sell to your employees. I think the argument to that is there's a lot of repositioning being done. From what we've talked to some investors, maybe buildings that were BC buildings, but they've put in a lot of infrastructure to support that back to office, really high end gyms, health aspects of it. Like I mentioned earlier, like UV systems for the HVAC systems, and all these clean seal kind of things to make people feel more comfortable. And if you could throw enough amenities and have it close enough to home that there's not a big commute, I think the expectation is those will perform really well.
Globe Street put out an article yesterday speaking to some of the migration from CBD into the suburban markets. And they said that for the first time ever, the suburban and CBD markets had an equivalent vacancy rate, which is a pretty interesting dynamic. Another thing on the investment side, there's been a 2-to-1 ratio of investment into suburban office compared to CBD over the last year. I thought that was interesting as well.
I wonder if that's a function of deal size, to where if you're looking to acquire office, investment groups are looking to acquire office, they're not going to take a big bet on a $100+ million asset in CBD versus a $10 million asset in the suburban area, or $5 million asset. I'd be interested to know who the buyer pool is, because for the most part, our clients have not been acquiring any office over the last couple of years. They're not really in the market. So
Yeah, well, the amount of investment into the office sector has gone down substantially, according to the report as well.
Yeah.
It sounds like a lot of items with class also bring in the idea of the tenant experience and bringing in, as you mentioned, some of those amenities. So it seems like not only is there a flight to quality, but that quality includes oftentimes a better tenant experience, which, maybe brings people back away from their couches into the office.
Yeah, I think that the challenge nowadays is not so much what it was a couple of years ago, trying to get the tech employees to stick around for 18 hours a day because you gave them everything within the campus environment. It's just a challenge of getting them back to the office at all.
Yeah.
But it feels like 18 months ago, the conversation is these high rises nobody's going to come back to the high rises because you're not going to want to ride in an elevator next to anybody else. You want these suburban office buildings with stairs you can walk up and wait for somebody to clear the stairwell before you go. I think a lot of that dynamic has been taken out of the equation. And that's where I think in the general feeling of office is totally different than it was 12 months ago. I think it's maybe fundamentals aren't that different in terms of rents and real projections of growth, but the general forecast and mindset is a little less ominous and a little less pessimistic.
Yeah, I would totally agree with that. And certainly that has played out now over the past 2 years. We've seen things starting to loosen up. People start to get comfortable with the idea of higher density environments. The thing I would add is, in general, I think that, many of us in America have pretty short memories. And we all recall the headlines after 9/11 about how nobody was ever going to work in a high rise again. Well, that obviously it just takes time, but folks get beyond things. And I think we'll see that going forward with office, even in the high density environments.
Yeah, well, you guys have been through cycles in the real estate industry and seen, the ups and downs and, the corrections. So in today's current market, is a correction inevitable? And, would you expect to see a recovery in, a year or 2 years? Or, if you have a crystal ball, the exact date would be great, but I don't expect anybody has that.
My mindset on that is it depends on what you're talking about correcting. I think the rate environment is going to have a value impact from a pricing standpoint, and we look at it from a valuation underwriting pricing aspect. I think office hasn't done as well. I mean, if you look at how most of the office stuff we've been valuing has changed over the last few years, the underwritten pricing, terminal rate, cap, discount rates, they haven't changed that much, where the rest of the property types have been compressed. Now, as everything starts to, you see the higher rates, debt rates and everything else going into things, I think it's going to have an inevitable impact on office space, but it's going to have an impact on everything. And then I guess to try to forecast out when rents come back, I think it's market by market. I think it just depends on where people are moving and where people are leaving. So.
Yeah, I would agree. And I guess this kind of assumes a presumption that we, are going to move into a recession. And, we're living in interesting times right now. It's just been, past several weeks where a lot of the headlines are pointing to an expectation of a slowdown, a lot more talk about a future recession. And as we're seeing interest rates spike and, probably we're going to have another 75 basis point increase in the Fed funds rate next month. And there's probably another one coming in September. And the goal of all that is obviously to slow things down. So, I do think we're probably moving into some period of, I hate to use the word recession or correction, but, things probably will be different going forward. And, what that's going to do to property values, it's probably not positive. And, demand for office space, again, I think with a longer term perspective, like the markets have before, we'll move through it all. And get back to a place where office is in higher demand and the fundamentals make better sense. But yeah, recently with regard to just the interest rate changes, we've seen certain deals fall through, and a lot of times it has to do with financing that's not locked in. People backing away from refinancing of properties because rates have spiked like they have. So it's, like I said, an interesting time and maybe an inflection point that we're sitting at right now, but who knows? We'll have to do this again in a couple months.
I find it interesting. We've been laughing in-house here when your clients, the investors, are starting to talk about how long they can stomach negative leverage, and you start scratching your head, but nobody wants to admit the party's over when it's over, right? So I think there's definitely sectors that have held on a hell of a lot better than office has. So I think this isn't maybe the forum to get to in all of those, but office isn't going to be the benefactor of any of it.
It should certainly be interesting to see how things shake out. I see a reduction in sales volume, and only transactions for properties that have to sell are going to be moving forward, or troubled assets that lenders are taking a hard look at. Other than that, you only realize losses when you actually sell a property. You only realize gains when you sell a property. So I think there's going to be a lot of investors holding on to their property and trying to weather the near-term future. And if there is a correction, I anticipate within the next few years, we would anticipate to see some reduction in vacancy and increases in rents if the stability comes back to the market.
It's a very enlightening conversation. I appreciate it, guys. Thank you for joining us on this discussion and your invaluable insights and observations about the future of office. Until next time, I'm Lucas Rudder, and this has been Opinions of Value.